Hello everyone, welcome back to another video lectures. So today we will continue with our chapter 11. So last time we already talked about how to recapture section 1231. So we talk about how to recapture section 1231 for each of the subset of the section, right? So we talk about section 1245 and section 1250, right? So now up until now we know how to do the recaptures, right? So after we do the recaptures, the recaptures of section 1231, right? After we apply the depreciation recaptures, so the next step for us is to net the loss and gain of section 1231, right? So after the whole thing, after we apply depreciation recaptures, if there's any section 1231 gain remaining, so now we have to net it, right? So imagine the taxpayers have who has several section 1231 disposition in a year, right? So in some of the transaction, this person may have some 1231 gains, and in some transactions they may have some 1231 loss, right? So, and recall the characteristic of section 1231 gain and loss, right? So for section 31 gains, the tax is going to be taxed at the differential rate, right? The 0, 15, 20%, and for the loss, it's going to be treated as ordinary loss, right? So we can just we can deduct it at the ordinary rate, right? So, but the tax law doesn't allow us to treat them individually or separately. We have to net them, right? It just you guys remember how we net the capital assets, right? How we net the long-term capital gain and long-term capital loss, and then short-term capital gain, short-term capital loss, and then at the end we net both of them together, right? Similar thing here, right? We have to net the section 1231 gain with section 1231 loss to find out whether or not this taxpayers at the end of the year he or she has net gain or net loss for section 1231, right? So if you look at this chart, it's kind of summarize the netting process. So start off at the gain properties, right? If we have so in this case, this taxpayer has he or she disposing multiple section 1231 assets, right? So some assets are going to have a gain, some assets are going to have a loss, and for the loss we don't have to do anything, but for the gain transaction you have to apply the depreciation recaptures, which we talked about in the last video, right? And then after that we net the section 1231 gain and section 1231 losses here, right? So if there's a net loss, then it's going to be treated as a ordinary income loss. If it is a net gain, then on the third step here we have to apply what is called section 1231 look-back rule, and we're going to discuss it right at this moment, and then at the end, whatever leftover after this final step is going to be the long-term capital gain, right? So so let's talk about what is this section 1231 look-back rule, and why there's such rule, So imagine a taxpayer who has multiple section 1231 asset disposition in the year, right? No, not in the year, just have multiple section 1231 assets, So this person, imagine they have like maybe, I don't know, a lot of section 1231 assets, and this person knows that some of the transactions going to result in a loss, and some of the transactions going to result in a gain, right? So because this person knows that, right, Now, and this version also note that the Section 1231 loss can be treated as ordinary loss, and Section 1231 gain can be taxed at very preferential rate. So if this person knows such thing, knows such details, he or she may want to plan carefully of which assets that she want to sell first and which assets she or she will want to sell later. Right. So recall the tax planning strategy. Right. We have the timing strategy. Remember. So in the timing strategy, we want to accelerate as a taxpayers. We want to accelerate tax deduction and defer, right, or postpone recognizing income, right, to defer the payment of the tax, right, because of the time value of money, right. So if a person has multiple Section 1231 dispositions, he or she gonna want to accelerate the disposition of the transaction that gonna result in a loss in the current year, right, first, right, and that might postpone, he or she gonna postpone the disposition of the assets that gonna result in gain in later years, right, in the second year, right. So in doing that, the person gonna be able to accelerate the recognition of losses, right, in the current year, and defer the recognition of gain in the later year, right. So that is the strategy that taxpayers may want to engage in, and that is what the IRS or Congress they want to discourage, because they're gonna lose tax revenue if taxpayers do such thing, right? So they want to discourage people to do that. That's why they came up with the Section 1231 look-back rule. So let's talk about how this rule gonna help them to achieve that. All right. So we already talked about this. Basically, what Section 1231 look-back rule does is that it requires taxpayers to recognize, to look back into the past if they have any losses in the prior years, and if they have such losses and in this year they have a gain, then they have to recharacterize the gain this year into ordinary gain, right? So so let's look at this text, right? So it says if a taxpayer recognize a net 1231 loss during the prior 5 years counting from the current year, so let's say this year, this is 2020, 2019, what we do in tax return here. So in 2019, so we want to look back 5 years prior to 2019, which is so we have 18, 17, 16, 15, 14, right? So starting for tax year of 2014, the taxpayer have to look back from 2014 to 2018 in the 5-year period to see if they have any net 1231 losses, right? So that means if in 2019 the taxpayer has a net 1231 gain, and in the prior 5 years they have a net 1231 loss, then they have to re-characterize the Section 1231 gain in 2019 as ordinary income to the extent of the net 1231 loss in the prior 5 years, right? All right, so that is basically the look back rule, right? So as the name suggests, we have to look back in the past 5 years to see if there's any losses, and then if there's, then we have to recharacterize the gain from in the current year as ordinary income, So in doing so, this rule kind of help prevent people to accelerating recognition of loss and then defer recognition of gain in later years, So yeah, so and remember that the gain and the loss, it has to be the net, right? So whatever we're talking about right here is the net, the netted amount, right? Remember this process, right? Whatever we talk right here is like this two amount, right? After the netting process at the end of the year. Does the person recognize the loss? Does the person recognize the gain? Right. All right. So yeah. So if the person recognize any non-recapture net 1231 loss in the prior 5 years, which have not caused the net 1231 gain in subsequent year, but prior to the current year, to be recharacterized as ordinary income, then in the current year the person had to recharacterize the net 1231 gain as ordinary income to the extent of the prior non-recapture 1231 net loss. So all that is just what I just talked about, right? Just mentioned, right? But what I want you to pay attention here is this line, right? Which have not caused section 1231 gain in subsequent year, but prior to the current year, to be recharacterized as ordinary income, right? What does that mean is, if the portion of the loss that we recognize during the 5 years period have already caused net section 1231 gain to be recharacterized as ordinary income in some year prior to this current year, then we don't count that net loss, right? So I'm going to demonstrate that right here in this small example. So let's see. Right, so we have a company here that they are disposing section 1231, so there are 5 years from year 1, 2, 3, 4, 5, 6, so year 6 is going to be the current year that we're going to be treated, right? We want to figure out how can we treat this $200 of net 1231 gain in the current year, right? And then we look back to the 5 year period prior to this year, to this current year, right? So we know in year 1, after we look back, right, we know in year 1 there's a net loss of $200. In year 2 and year 3 there's nothing, so they didn't dispose, or the net just resulted in a zero, So in year 2 and year 3 there's nothing. In year 4 there's a net gain, right? And then year 5 there's a net loss of $50, and then in year 6, which is the current year, there's the net gain of $200, right? So what we do is we look back to the 5 years period, right? So we know that in year 4 there's already a net gain here, right? So that means this loss of $200 already being used to recharacterize of the year 4 net gain, right? So under net gain here we say recharacterize ordinary income $100 in year 4, right? So at this point the net we have like $100 of net loss left, right, to be used for the current year, right? And then in this year there's another additional $50 of net loss, right? So by the current year, by year 6, the amount of net loss, right, the extent of net loss that have occurred in the prior 5 years is going to be negative. It's going to be $150, right? It's supposed to be $250, but we already used $100 to recharacterize the net gain in year 4 to be ordinary income, right? So now what we have left is $140 of net loss, right, in the period of 5 years prior to the current year. All right. So because of that, because we have $150 of net loss, right, we have to recharacterize $150 of the net gain in this year to be ordinary income, right? So out of the $200 of net gain recognized in year 6, right, in the current year, $150 is going to be recharacterized as ordinary income, and then the leftover, the remaining $50, is going to be treated as Section 1231 gain, right? And it's going to be taxed at a preferential rate, right? So I hope with this demonstration, it's going to help you guys to understand how we can apply the Section 1231 look-back rule. You know, so even though it's there's a lot of wording, and I know in the book they discuss a lot about this, but what I just want you to remember is how to basically understand this demonstration. You know, this table. You know, if you understand this table, you can pretty much know how to apply the Section 1231 look-back rule. All right. So all right. Then let's look at another example. You know, so the example is kind of similar to the one I just showed you. You know, but let's see. Right. So the problem said, suppose that Titan, the company, right, began business in year 1, and that it recognized $7,000 of net Section 1231 loss in year 1, and assume that the current year is year 6, and that Titan reports a net 1231 gain of $25,000 for the year, right? And then the company did not recognize any Section 1231 gains or losses in year 2 and 5, right? So, and for year 6, what would be the ultimate characters of the $25,000 net 1231 gain, right? So in this problem, right, the only loss amount that we have in the 5 year prior to the current year is the net loss in year 1, right? The net loss of $7,000 in year 1, right? So out of this $25,000 net Section 1231 gain, $7,000 is going to be recharacterized as ordinary income, right? And then the remaining $18,000 is going to be treated as Section 1231 gain, which pretty much is the long-term capital gain and going to be taxed at a preferential rate, right? So yeah, so that's pretty straightforward, right? And then it also asks, assume that the same facts as above, except that the company also recognized the $2,000 of net 1231 loss in year 5. For year 6, what will be the ultimate characters of the $25,000 net 1231 gain? Right. So now we have additional loss, right? So now the additional loss going to bring up the extent of net loss in the prior 5 years to $9,000, right? So now we have to recharacterize $9,000 of the $25,000 here as ordinary income, and then the remaining $16,000 is going to be treated as Section 1231 gain, which is going to be taxed at the preferential rate, right? All right. So yeah, as I say, it's pretty straightforward, right? And if I have something like this in the test, I hope you guys can do it. You know, it's pretty straightforward. All right. So that was the end of the discussion about Section 1231 recaptures. You know, so in the next part, we're going to discuss about some scenarios, some situations where the disposition of assets doesn't result in an immediate recognition of gain, right? All right. So you know, some let's say there's a lot of way for taxpayers to dispose the assets, right? They can sell it. They can you know, most of the time people are going to sell it to someone else, right? Sometimes people do an exchange, you know, say two taxpayers, two parties, each of them has a piece of properties, you know, and somehow they want to exchange the property to each other, you know. So Mr. A is going to have a piece of land, and Mr. B has a piece of land, and Mr. A interested in Mr. B piece of land, so he offered Mr. B to give Mr. B his piece of land in exchange for Mr. B's piece of property, you know. So for those kind of transactions, you know, taxpayers may not have the change in the economic position to even pay the tax, right? Because if a guy just exchange piece of land, right, there's no cash generated, and if it's a purely an exchange and there's no other say additional payment to the in the transactions, then the economic position of each of the taxpayers should remain the same, right? And they don't have any additional cash result anything, right? So in those cases, you know, the IRS, the Congress, they kind of give taxpayers a break, you know. They allow taxpayers to to not recognize the gain right away, right at the moment of the transactions, and they allow them to defer paying the tax, right? So for the rest of the video lecture today, we're going to talk about those kind of situation, you know. So there are so the example I just mentioned is just one of the several cases where the IRS allow taxpayers to postpone paying the tax, and postpone recognizing the gain, you know. There are some other scenarios as well, you know. For example, if a taxpayer is forced to convert to dispose of his asset, you know. Maybe the asset, the properties got damaged by some natural disasters, you know, and somehow they're involuntary need to dispose of the asset, you know. So that's another scenario where they are allowed to postpone the engagement, the recognition of the gain, right? If there's any gain, right? And another scenario is when the taxpayers have an installment sale, you know, meaning they don't receive all the cash that they are promised to receive on the first right at the moment of the transaction, you know, and they have to wait for a long period of time until they can receive all of the proceeds from the transaction, you know. So for those kind of transactions, the IRS also allow taxpayers to wait, you know, to postpone the recognition of gain as well, right? So yeah, so those are the few scenarios where the IRS allow taxpayers to defer the recognition of gain of a gain, and we're going to talk about each of those scenarios, you know. So first, let's talk about like-kind exchange rate. So like-kind exchange is exactly what I mentioned in the first example, right? So imagine there's two parties who want to exchange a piece of properties to each other, you know, and there's nothing else involved. They just Mr. A, Mr. B just exchange each other their property, you know, and there's no cash payment, nothing else involved in the transaction, you know. So for that transactions, it can be considered as a like-kind exchange transaction, you know. So what is like-kind exchange, right? So for an exchange, for a transaction to be qualified as a like-kind exchange, there are several requirements, several criteria that the exchange have to meet, right? So here are the three criteria that they need to meet. So first of all, has to be real properties, you know, and the real property is exchanged solely for like-kind property, meaning a piece of property exchanging for another piece of property, you know. So it cannot be a piece of property exchanged for a truck, right, or a piece of machine, right? It has to be a property exchanged for like-kind property, right? And it cannot be a personal property. It has to be real property exchanged for real property, right? All right. And the second requirement is that both of the real property given up and the real property received in the exchange, both of them has to be used in trade or business or held for investment by taxpayers, right? If the piece of property is used as some other purposes, then it is not going to be able to meet the like-kind exchange requirement, right? And then the third requirement say that the exchange, it has to meet certain time restrictions, and we're going to discuss about that in a little bit, So first of all, let's talk about let's talk about the first criteria. So as I mentioned, right, it has to be real properties, right? And the real property has to be the real property used in a trade or business or held for investment, right? So all other purpose of real property cannot be considered as like-kind properties. It has to be properties used in trade or business or held for investment. All right. So, for example, what are the properties that cannot be considered as like-kind property? So let's say a person, right, Mr. A has a house, his residential house, and then somehow he wants to exchange for a piece of Mr. B farmland, because Mr. A wants to expand his farming business, right? So he's exchanging his residential home to he's offering his residential home in exchange for Mr. B's piece of farmland, right? So in this case, even though both of the piece of properties are real properties, they are not personal properties, but Mr. A is offering his residential house, right, which is not a property used in trade or business or held for investment, right? So because of that, this transaction cannot be qualified as a like-kind transaction. It's not. So yeah, so that's just an example about this requirement, right? So both of the properties exchanged has to be used in trade or business, or they have to be held for investment to be able to meet this requirements. All right. So here are some of the example of properties that are not eligible for like-kind properties. So so properties held for sale, right? So so this kind of properties, usually they can be considered, you can think of them as like inventory of some people, of some businesses, so like a real estate investor, right? So, or let's say real estate developers, right? So real estate developers, he probably has multiple pieces of properties on his in his hand, in his inventories, and then he's gonna sell it to people during his normal course of business, right? So this kind of property cannot be used in a like-kind exchange. It cannot be treated as a like-kind properties, So the first case, and the second case is you cannot use a property that is outside of the U.S. to be treated as a like-kind property, So an exchange between a piece of properties in the U.S. and a piece of properties in say the Bahamas, right? That exchange cannot be considered as a like-kind exchange, right? Because the piece of land in Bahamas doesn't meet the requirement of a like-kind exchange, right? And then the third case is when well, we should talk about the third case here, but the third case here, but the second case I haven't talked about. So the second case is when taxpayer exchange a piece of land in China, you know. So two taxpayers, they are U.S. Taxpayers, but both of them have own properties in China. I'm not sure if they are allowed to do that, but just for the sake of the example, you know, let's say two U.S. Taxpayers have some properties in China, and then they want to exchange to each other, you know. So even though their exchange can be purely exchange, you know, there's no payment, no cash, no nothing involved. They just exchange the ownership of the piece of land in China, you know. But because the exchange happened outside of the U.S., it also doesn't meet the requirement to be considered as like-kind exchange. All right. So here are some of the cases where the properties are not eligible to be considered as like-kind properties, you know. So we have to be careful of the characters, the characteristic of the transaction. All right. So property use also, we kind of talk about this, right? So the exchange must be in between properties that are used for business and investments. It cannot be a personal use, cannot be residential properties, right? And regarding the timing requirements, right? So this requirement is created to mostly for transactions that involve third-party intermediaries, you know. So, you know, even though, like the example that we talked about, right, like Mr. A, Mr. B exchange land to each other, in real life might be hard to find such partner, such person who willing to exchange land for you, right? So most of the time, exchanges like this may involve third party, you know. So you look at this diagram, it kind of tells how the third party may involve, right? So imagine we are the taxpayers right here, right? We are taxpayers. We have a piece of land, but we want to exchange it to get some other piece of land, right? But as we know, it's maybe difficult to find a person who has a piece of land that fit that we want, right? And also like to do an exchange to us, right? So that's why we want to involve a third party intermediary here. So this is pretty much a brokers, you know. So we're gonna go see the brokers and we offer them the deal, you know. We say, okay, I have this piece of properties and I want to exchange my property to get another properties, you know. So the third party is gonna go advertise and then go try to find a buyer for our properties, right? So the third party is gonna sell that to a buyer and then receive cash, and then right after that, the third party is gonna go out and try to find a seller of a property that we, right, the taxpayers desire, right? So and then they're gonna go buy that property, right? Give them the cash, and then they're gonna give us the property that they acquired, right? So that's how it works, right? Roughly, right? There's gonna be a lot of other stuff involved, but roughly that's just how it works, right? So as you can see, this whole process may take a lot of time, right? So that's why there's a timing requirement to be considered as a like exchange, right? All right, so the requirements, there's two parts of the requirement. So first of all, taxpayers must identify the replacement of like-kind property within 45 days of giving up their properties, right? So after after giving up the property, after they sell, after the third party finds some buyer and the taxpayer giving up the ownership of the properties, right? They have 45 days to identify sellers, identify the replacement Lakai property, right? Identify this guy who owns the properties, who owns the replacement property that the taxpayer decides, right? All right, so they have 45 days to do that. Since from the day of they are giving up ownership of the Lakai properties here, right? So they have 45 days to file replacement properties. All right. Oops, sorry. Right. And then the second part of the requirement say that the Lakai property must be received within 180 days of when the taxpayer transfer the property in a like-kind exchange, right? So the taxpayers must acquire the replacement properties within 180 days since they involve in the transaction, right? Since they give up their Lakai properties, right? So they have 180 days. So again, they have 45 days since the day they sold the properties to file the replacement, and they have 180 days to wrap up, to complete the transaction, right? To receive the piece of land, right? All right, so that is the timing requirement for like-kind exchange, right? So what happened to like-kind exchange, right? In terms of tax, right? How do we treat the tax for such transaction, right? So as I mentioned earlier, right, because this is a purely exchange of properties, right? There's no cash, there's no nothing else involved. It's just exchanging a piece of land to another to receive another piece of land, you know. Because of that, the economic position of the taxpayers should not change, right? So, and also the taxpayers may not have the cash to even pay for the tax rate, because there's no cash involved. It's just exchanging a piece of land to another piece of land, right? So that's why like-kind exchange, the IRS don't require taxpayer to pay tax on like-kind exchange, you know, because they don't recognize the gain or loss, right? So that's why, as I mentioned, right, IRS allow taxpayers to defer the recognition of gain until later when they sell the property or somehow, right? But at the moment of the exchange, the taxpayer don't have to recognize any gain or losses on the exchange rate, right? So let's look at this example, right? So let's say tenant trades land worth $25,900 with the adjusted basis of $18,000 for land in a different location that is also worth $29,500. And it asks how much gain does Titan recognize on this exchange. The answer is 0, right? Like we said, right? Because this is a purely like-kind exchange, right? There's nothing else involved, right? And the gain here, the gain that is realized, which resulting from the appreciation of the land, right? It's going to be deferred. The gain of 11,500 here is going to be deferred until later, right? And that's what the basis of Titan in the new land. So the answer is $80,000, right? And that's another thing I want to point out to you, right? So in an exchange, in a like-kind exchange, in a pure like-kind exchange, right? The taxpayer is gonna roll over the basis of the old properties to the new properties. So in this case, Tetons, right? The old piece of land adjusted basis was $18,000, right? And then we don't know what the basis on the new piece of land is. We just know the value, the fair market value at the moment is also $29,500. Right? So what Teton can do is they can use the $80,000 of basis in the old piece of properties and use that to use that as the adjusted basis for the new piece of properties, right? And that's why they say the gain is deferred, right? So because the adjusted basis still keep the same, right? So later on, when Teton maybe if they want to sell this new piece of land, they're going to use exactly the same basis here, right? $80,000 to calculate the gain or loss, right? And then at that moment, the gain or the loss is going to be recognized later, right? That's why we say it's the deferred gain or loss. All right. All right. So what we just talked about is a pure like-kind change, like that's what I like to call it, like a pure like-kind change rate. There's nothing involved. There's just purely a change of a piece of land to get another piece of land, right? So what if there's some cash involved, there's some other kind of payment, you know, cash or some other piece of properties that are involved in the transactions? So what can happen, right? So in a transaction that involve both like-kind properties and other non-like-kind properties, we call the non-like-kind properties as put, you know. And don't ask me about already like why they call it put, you know, because I don't really know why they call it put. You know, if you guys know, you can tell me, but I don't really know. But okay, but just call it put, right? So kind of situations is usually when the properties exchange is like the value of the two properties that are in the exchange are not equivalent, you know. So in the previous example, right, in this example we know that both of the land are worth $29,500, right? But in the case when there's boot involved, the value of the two pieces of land is going to be different, right? That's why there got to be some boot, right? Some other properties thrown into the transaction for the exchange to happen, right? So boot can take many forms, right? It can be cash, it can be some pieces of personal properties, it can be another piece of real properties, right? So usually even though a transaction that has both like-kind property and non-like-kind properties is still can be considered as a like-kind exchange, you know. So that is a bit the rule is kind of a bit loose when it comes to the boot, right? Because now the boot can take many forms and can is already like doesn't meet the like-kind properties requirement, right? But still the tax treatment for the transaction that involving both like-kind exchange and non-like-kind exchange still can be considered as a like-kind exchange, you know. And the like-kind portion of the exchange is still non-tax. Is still the gain of the gain of the like-kind portions in the like-kind exchange is still deferred. Right? the portion of non-like kind properties, for that the gain has to be recognized, right? So overall, is even though it's, in the book they say it can still be considered as a like kind exchange for this kind of scenarios, but still the gain has to be recognized, right? But only to the extent of the boot received, right? So let's look at this example. So overall, the gain, the extent of the gain recognized is going to be either the boot received or the gain realized, whichever is lesser amount, right? But let's look at this example with a value of $29,500 and an adjusted basis of $80,000 for land in a different location, value at $27,500, right? To equate the value of the property exchange, the other party also pays Titan $2,000 in cash. What is the gain and loss does Titan realize on the exchange, and what gain and loss does Titan recognize on the exchange, right? So we know this piece of land that I received is going to be worth $27,500, right? And plus we have a boot amount of $2,000, right? So in total, the amount realized is still like $29,500, right? And we have an adjusted basis in our old piece of land, right? In Titan's old piece of land is $80,000. So we can see the gain realized is $11,500, right? It's still $11,500, right? But because there's boot involved in this case, right? Because Titan is receiving a $2,000 boot, it has to recognize the gain of $2,000, right? So the rules say the gain recognized is going to be the lesser of gain realized or boot received, right? So in this case, gain realized is $11,500 and boot received is $2,000. So the amount gain recognized is going to be $2,000. All right. So yeah. So let's move down. So how do we calculate the basis in the received properties, in the replacement properties, now that we have boot involved in the transactions, So there's a formula to calculate the basis in the like kind property received, right? So what we do is we take the adjusted basis of the like kind property surrender plus the adjusted basis of the boot given, right? And plus gain recognized, subtract fair market value of the boot received, right? And subtract loss recognized, and that equal basis of like kind property. This example, right? So you say assume that well, we just talk about this, right? Example, assume that Titan exchanged the land with the value of $29,500 and an adjusted basis of $18,000 for land value at $27,500 and $2,000 cash, right? And Titan already recognized $2,000 gain on the exchange, right? We know this from the last example. So the question asks, what is the basis in the new land you received from the... So in this example, the way that they solve here is what is called a simplified method. So what it does is they take the fair market value of the new land, is subtract the deferred gain to get to the adjusted basis of the new land. So we know the fair market value of the new land is $27,500, right? And then the deferred gain after we calculate here is going to be $9,500. So that's how they calculate the adjusted basis of the new land, right? Take $27,500, subtract $9,500, right? But let's see if we can solve it using this way, using the more sophisticated way, right? So let me open the Excel sheet. right? So it will follow this method, right? So first of all, we take the adjusted basis of like-kind property surrenders, which is $18,000, right? Plus adjusted basis of boot given. Given mean the taxpayers is giving the other party something else, right? Which is none in this case, right? Because in this case, the company, the taxpayers only give the piece of land, right, which was 29,500, right? All right. So here we have 0. Gain recognized. So gain recognized, we know it's $2,000, right? And subtract fair market value of boot received, which is $2,000, right? And then subtract any loss recognized, which is 0, right? So in the end, the sum of all this is also $18,000, right? Similar to this way, right? So there's two ways. This is a more like simplified way, and this is like a more complex, sophisticated way, you know. So I give you the formula of the sophisticated way here, you know. So yeah, but either way, it should give you the same answers, right? All right, so let's move on. So let's talk about the involuntary conversion. So at the beginning of this section, right, we already kind of told you about some cases when the taxpayers are involuntarily have to dispose their asset, you know, their properties. It could be because there's some natural disaster, you know, maybe there's an earthquake and somehow the land and the building is just ruined, you know, or there's a volcano erupt and then the whole piece of land filled with lava, something like that, you know. So in those cases, the taxpayers have to involuntarily dispose the land, right, because it's not usable, it's destroyed, right? So usually, if they have insurance, you know, maybe they can be compensated somehow, you know. Can be the case that the insurance company can give them a replacement piece of land with equivalent value, or the insurance company is going to give them a compensation in cash, you know. So the first case, right, when the insurance company give them another replacement piece of land somewhere in some other location, that action is called a direct convert, right? So in a directly converted exchange, the basis of the properties is going to be carried over from the old properties to the new properties, you know, the property that has been destroyed, right, to the new properties that they has been given to by the insurance company, right? In the case when the insurance company gives the taxpayers cash in compensation, right, this is called indirect conversion, right? So in this case, the gain is going to be recognized, right, because they receive some cash, right? So in this case, the gain is going to be recognized, and the amount is going to be the lesser of the gain realized or the amount of reimbursement that taxpayers does not reinvest in qualified properties, right? Because a lot of times when taxpayers receive a big chunk of cash, you know, maybe they not go back and buy a similar piece of land, you know, they may invest in something else, or they do something good with the money, right? So that's why the recognized gain is going to be enforced here, right? So yeah, so the gain recognized is going to be the lesser of the gain realized, or the amount of the reimbursement the taxpayer does not reinvest in qualified properties, right? So that means if the taxpayers invest 100% of the cash received from the insurance company, right, to buy a qualified properties. That means they may not have to recognize gain, right? All right, so what can be considered as a qualified property, you know? So a qualified properties it has to be similar and related use to the original properties, you know. And the taxpayers have to acquire the qualified property, the qualified replacement property within a timeline. Usually it's 2 to 3 years, you know, if they want to defer the realized gain, right? So let's get back to the discussion of what can be considered as a qualified replacement properties, right? So usually the definition for qualified replacement property is pretty strict, right? You cannot just buy a similar piece of property, you know. So let's say if the taxpayer have a rental office building, right, then a qualified replacement properties would be another rental office building, right? The taxpayers who lost the rental office building cannot use the money, the compensation cash, to buy, say, a residential rental company, residential rental building, right? It has to be the same. It has to be of the same use of the old properties, right? So yeah, so we just need to be careful about the definition of the replacement properties. All right, and let's talk about installment sale, right? So as I mentioned, right, installment sales mean the sale that the taxpayers does not receive all the cash at the moment of the transaction, right? So it's like selling a house, right? When you sell a house, usually you're going to receive what the buyer will pay you. Maybe it's going to be a down payment, and then over the course of the year, they're going to pay. Every year they're going to pay a small sum of money in a defined period of time, right? So same thing for installment sale, right? So because the taxpayers don't, the seller, right, the taxpayers who's selling the properties does not receive all the cash at the moment of the transaction, right? That's why they are allowed to defer a portion of the gains until when they receive additional cash, right? So, but still, the taxpayer have to recognize the portion of gain at the current time, right? And every time there's an installment coming in, right, they have to recognize a portion of the gain, right? So they're doing that by applying a ratio, right? It's called gross profit percentage, which we take the gross profit divided by the contract price, right? Yeah, and there's some and this installment sale rule does not apply to all of the properties, right? So all of the asset, right? So for example, inventory, marketable securities, depreciation recapture properties, for this kind of property they cannot be applied to the installment sales transaction, right? So let's look at this example, right? And this example is, I took it from your homework, so hopefully it helps, right? So it says Ken sold a rental property for $730,000, and he received $154,000 in the current year. and $144,000 in each year for the next 4 years, right? So you can say the down payment is $154,000, and then in the next 4 years there's going to be an installment coming in every year in the amount of $144,000, right? And on the sales price, $535,000 was allocated to the building, and the remaining $185,000 was allocated to the land. The Ken purchased this property several years ago for $522,000, and he initially purchased when he initially purchased the property, he allocated $400,000 for the purchase of the building and $122,000 to purchase the land. And he claimed $47,500 of depreciation deductions over the year that he owned the building, right? And he had no other sales of Section 1231 of capital assets or capital asset in the current year. So the question asks, what is the amount that can recognize? What's the amount of gain or loss that can recognize in the current year, right? So first of all, we have to calculate the ratio rate, the gross profits percentage, right? Yeah, my laptop decided to quit on me again. But so to calculate the ratio, first we have to calculate the realized gain, right? So we know that the sales price was $730,000, and we know that we can calculate the adjusted basis, right? So we know the depreciation was $47,500 for the building, so we can calculate adjusted basis for the building, right? So we take $400,000, subtract $47,500, and then we plus the basis for the land was $122,000, right? So in here they kind of shortened the calculation, but it is the same, right? So we know the adjusted basis was $474,500, right? So we can calculate the gain realized, which is $255,500. All right. So now that we know the gain realized, we can calculate the ratio rate. So we take the gain realized divided by the contract price of $730,000, and that gives us 35%. Right, that gives us 35%. Right. So now we just use this ratio to calculate the amount of gain that had to be recognized. Right. So in the first year, this guy received $154,000. So we just take $154,000 times 35%, right, and that gives us $53,900, right? All right, so yeah, so pretty easy, right? You just need to calculate the cost percentage, the gross profits percentage, right, and then just apply that to the amount that received in a year to calculate the the recognized gain, right? So the way we do this is kind of you guys remember about annuity, right? How we calculate profit portion of annuity. Same thing, right? We just pretty much calculate the ratio of gross profit, right, and apply it to the amount received every year. All right. All right, and the last thing I want to talk about in this chapter is what about transaction with related person, you know. So there's a rule called related person loss disallowance rules. So basically this rule say that losses on the sales to a related person are not deductible by the seller, right? So let's say, and then as we discussed in earlier the chapters, right? We know that the definition for related person can be very broad, right? It can be a entity, a company that are owned by someone, right? And then if the person sell that thing to the companies, then it can also be considered as a related person transaction, right? So for that's the previous sellers disallow to recognize, right? So the buyers, if the buyers later on, the related buyers later on decide to sell the properties to someone else, right? Then he or she may be able to recognize the loss that are disallowed by the sellers, by the previous sellers, right? And the amount of loss that can be recognized is the extent of the gain on the sale that the unrelated the extent of the gain on the sale to the unrelated third person, right? So basically, the loss there is going to be if the loss amount exceeds the amount of gain on the sale to the unrelated third person later on, it's gonna wipe the whole amount of gain that the related person, the second related person has on the thing, right? So they don't have to pay any tax at all, right? So whatever loss that disallowed by the seller, the initial seller, right? The related person can recognize later in the futures, right? So that's why again it can be considered as like a deferred version of loss, right? So yeah, so that's it. That's the end of chapter 11. So after this, I will create a review section video, to show you how you can prepare for exam number 3. So exam number 3 is going to be in almost 3 weeks, right? It's going to be on the 23rd. No, more than 2 weeks, right? So I hope you guys pace yourself correctly and prepare for exam number 3, right? So I try my best to upload the review session. Sometimes I will. Well, first I have to see what I can test. I have to design my test first, right? This week, and then maybe I will create a review session and upload it to Blackboard sometime next week. So you can start preparing for your test, right? All right. So that's it. We're almost there. We're already chapter 11, and after exam 3, there's going to be 2 or 3 more chapters, and then we'll be done with our semester. So all right, I'll see you in the next video. Take care.